takes us to our talk of the tape. And if hopes of coming rate cuts can sustain this rally, joining me now is Edward Jones Mona Mahajan and Truist Wealth's Keith Lerner. It's great to see both of you today. Mona, set the scene for me today because there was so much expectation going into Fed Chair Jerome Powell's speech in Jackson Hole today, the expectation of rate cuts, but he came out and he stated it fairly clearly.
Yeah, thanks, Contessa. Look, the chair delivered on his message today, and I think they usually tend to use this Jackson Hole symposium as a platform where they can deliver or signal a change in policy. And Fed Chair Jerome Powell did just that. You know, not only did he say the time is now for a change in policy, he also alluded to both sides of his dual mandate that have come now into focus. So, of course, the inflation side continues to deliver well as well. We've seen CPI inflation with a two-handle now, 2.9%. Powell commented on that, saying his confidence in inflation moving lower has actually increased. But of course, they're now much more focused on the labor market as well. And that has softened. And he noted that he does not want to contribute to further softening in the labor market. So in our view, net, he has signaled a September rate cut. We still think it's a 25 basis point rate cut. We don't see the urgency for something larger. And we think 2 to 3 rate cuts are likely for the remainder of the year.
Keith, what's your take?
Well, first, great to be with you. I think, Mona, she summed it up well. The market wanted to see the rate cuts, and Powell's delivering. I mean, he was very direct. I think the market was already pricing in 100% probability of a rate cut, but they still wanted to hear it from Powell. And what you see this morning, maybe overdoing it a little bit, but now the market is now pricing in a 40% chance of a 50 basis point cut in September. I think the more important message is that the Fed has now shifted their focus to the employment side, and they should, right? The unemployment rate today is above what they thought it was going to be at the end of next year. And as a result of that, you have an economy that is cooling, but this should probably provide some support as we move into later this year. And you're seeing the more interest rate sensitive areas of the market lead today.
When you're looking at the Dow Jones up nearly 1%, the NASDAQ, the S&P 500 almost 1%, and then the Russell 2000, Mona, what does it tell you about what's to come based on this expected rate cut in September?
Yeah, you know, we continue to feel like this broadening of market participation and leadership has some legs here. And we thought there would be two catalysts that drove that. One would be getting closer to Fed rate cuts, which I think we are notably closer now. We think September is the start there. The second one would be a broadening of earnings participation as well. So if you look towards what's happening in Q3 and Q4 of this year, it's actually the contribution to earnings is coming much more meaningfully so outside of tech than it is within tech. And so, yes, tech is contributing, but certainly not more than 50% of earnings growth. And so we think both of those catalysts combined lead to this broadening of earnings. But we'd say from a cap structure, market cap perspective, we still like large and mid cap as a way to play that diversification theme. Longer term, we're a little bit more cautious on small caps. They are more levered and they tend to have less positive earners, you know, more of those quote unquote zombie companies. But all that being said, we think if you get more volatility in the weeks ahead, we wouldn't expect this pace of gains to continue at this pace for the remainder of the year. So if you get that volatility, it's really your opportunity to use that to your advantage to get some diversification.